Good afternoon. We will be representing San Jose State's Department of Hospitality Management. We are excited to share with you our hotel market study of the Los Angeles Long Beach market in California. We are your San Jose State team: Kevin Fordian, Renafel Atud, Yvonne Pan, Yuming Ma, Joshua Peck, and of course our advisor, Dr. Ging Hua Huang. We would like to thank Share Center of STR and STR Global for giving us this opportunity to share the information with all of you. We also received additional insight from these business professionals. These are the segments of our study that we will be sharing with you. We begin with a brief introduction of the Los Angeles Long Beach market and conclude with the forecast for the next 4 years.
The Los Angeles and Long Beach metropolitan area is located in Southern California and has a population of 13.3 million people. Welcome to the Los Angeles Long Beach metropolitan area. Here are a few of the major companies based in this area. One thing to note is that there are a lot of broadcasting and entertainment related businesses. Shown here are some of the major attractions in the Los Angeles Long Beach area: the Los Angeles Convention Center, Hollywood, Santa Monica Pier and Beaches, and the Queen Mary. Los Angeles and Long Beach area hosts a lot of meetings and events throughout the year. For example, major annual events include the Golden Globe Awards in January, the Grammy Awards and the Academy Awards in February, Anime Expo in July, and the Greater Los Angeles Auto Show in November. Now, why would people want to visit the Los Angeles Long Beach area? Well, because of the growth of the economy, the world-famous tourism attractions, and the major events. The Los Angeles and Long Beach area attract many different types of visitors. Both leisure demand and business demand are high. The group meeting travelers also make up 1/3 of the visitors coming to this area.
This is where the Los Angeles market currently stands. Mayor Eric Garcetti projects an annual increase in total visitors to the LA County after 2016. We are curious to see how the hotel industry in the Los Angeles Long Beach area will accommodate this increase in visitors and demand. Also, will the hotel industry be ready to provide the service that is needed? Therefore, using the data from multiple data companies, interviews with business insiders, analysis reports, and our best friend Excel, we were able to discover some insights from STR dataset of the Los Angeles Long Beach market. But first, here are some of the statistics of the Los Angeles Long Beach market.
Since 2012, the overall statistics of the Los Angeles Long Beach market have been rising. Currently, the market is doing very well based on the 12-month data between August 2015 and August 2016. The Los Angeles Long Beach market ranks number 1 in hotel count. The current occupancy, ADR, RevPAR, revenue, and room supply hit an all-time record in its history. The occupancy, ADR, RevPAR, and revenue also rank high in the U.S. market. While the Los Angeles Long Beach markets rank number 1 in the hotel count, it can be seen as number 6 in the total room supply. This is because most of the hotels in the market are small. There are less than 100 properties that go over a 300 room count. So far, in 2016, the room supply is the highest it's ever been. As you can see in this graph, the overall supply and demand have been constantly increasing over the past 5 years. In addition, the increasing demand outspaces the supply growth.
The market holds the 4th highest occupancy rate at 81% in the United States for 2015, just below the San Francisco San Mateo market. A steady occupancy also results in the market having the second highest total room revenue in 2015 at over $4.8 billion. The market is currently 8th in the United States with $134 of revenue per available room. The market has experienced a steady RevPAR growth rate of 11.7% from the 2014 to 2015.
This slide summarizes the KPIs, or the key performance indicators, which shows you the progress growth of the occupancy, ADR, and RevPAR in the years of 2012 through 2016, which I will go in more in depth in the next 3 slides. This slide focuses on the progress of the overall occupancy for the past 5 years. As you can see, the rate of occupancy is slow due to an already high overall occupancy. The key performance of the average daily rate grows faster from 2015 to 2016. The overall ADR went up from a $40 million leap since 2012. The Los Angeles and Long Beach market has had a rapid growth in revenue per available rooms in a span of 5 years.
Here, we move into the general market makeup of the Los Angeles Long Beach market. Shown here are the hotels in the Los Angeles Long Beach area, which comprises of 1,001 hotels in total. Many of the hotels in this market are small. 817 of the hotels have less than 75 rooms. You can see the disparity between the number of economy class and luxury class hotels in this market. Luxury class properties are clustered around Santa Monica Beach, Hollywood, and Beverly Hills. This following map zooms in and shows the distribution pattern of mid-scale through upper upscale class hotels in this market. The hotels are color-coded by class. Hotels are clustered around the beaches, the airport, the convention center, Hollywood, and Beverly Hills. Here is the room supply breakdown by submarket. The room supply breakdown differs from the property breakdown, especially because a lot of the hotels in the Los Angeles Long Beach market are smaller. Generally, the room supplies are concentrated nearby airports and major tourist attractions, such as Hollywood, Beverly Hills, and Santa Monica Beach. Here is a table breaking down some of the data in the previous slides. Majority of the hotels are concentrated in the economy class, with 57% of the properties, and account for about 30% of the room supply in the market. Upper upscale class follows in second, with 24% of the room supply, but only 9% of the total properties in the market, which means they tend to be bigger hotels. Here are the top 10 chains in the Los Angeles Long Beach market. Let's move into the market breakdowns now. Pictured here is the Westin Bonaventure, the largest hotel in the market. It's located nearby the convention center. Here you can see that the demand is constantly going up, especially in the upper mid-scale and upscale classes. But the economy class and mid-scale class supply are dropping. Why? One explanation that we have is due in part to competition from Airbnb, which adds over 15,000 rooms to the market room supply in the city of Los Angeles alone. Occupancy is high in all the classes, but upper mid-scale and higher class hotels are performing better. The average daily rate is increasing by almost 10% in some classes, while occupancy is still staying strong from last year. Here, you can see that full-service hotels are making more profit, almost double of what limited-service hotels are making in ADR, revenue per available room, and GOPAR, but limited service hotels are showing more revenue growth over the last year in those same areas.
Next up, we'll take a look at some longitudinal trends of the Los Angeles and Long Beach market. This graph represents the total yearly supply and demand of the Los Angeles and Long Beach market. Significant events in the past decades have helped and hurt the supply and demand. For example, in the 1980s, many Japanese investors came to invest in the real estate market in Los Angeles and Hawaii. Many hotels were built in the 80s, as you can see from the significant growth of supply from the mid-80s through the early 90s. However, in July of 1990, an 8-month-long economic recession began, causing the demand to drop. Then, the hotel developers became very cautious about adding new supply to the market. Therefore, you can see the supply remained stagnant during the 90s. Let's take a look at another graph about the supply percent change versus the demand percent change from 1988 to 2015. It is noticeable that after the supply boom in the 80s, the supply never really gets close to that height again, whereas the demand fluctuates throughout the years. The three dips of the demand percent changes are caused by the 1990 recession, 9/11, and the 2009 recession. This graph represents the occupancy and ADR from 1989. As you can tell, after 2009, both the ADR and the occupancy skyrocketed to the top of the chart. As I mentioned in the previous slide, there was an economic recession in 2009. Once we climbed out of the recession, the tourism and business began to thrive in the Los Angeles Long Beach area again, causing the occupancy and ADR to bounce back strongly. Let's have a closer look at the occupancy percent and the ADR percent change pattern. From the 90s until 2010, the occupancy percent change and ADR percent change move in similar patterns. But after 2010, though, the pattern changes. When the ADR growth began increasing, the occupancy growth slowed down. This indicates that the occupancy is nearing its limit now, with a historical record of 80.8%. As of August 2016. This graph demonstrates the cycle of RevPAR growth. So far, the Los Angeles and Long Beach market has experienced RevPAR growth for 68 consecutive months. Comparing to previous cycles, there were 70 consecutive months of growth before the 2009 recession and 92 consecutive months of growth before the 9/11 attack. Therefore, we expect this RevPAR growth cycle will come to its end within 2 years or so.
Comparing the Los Angeles Long Beach market to the three competitive markets of San Francisco, San Mateo, Anaheim, Santa Ana, and San Diego. We chose the San Francisco, San Mateo, and Anaheim, Santa Ana as the primary comparable markets because both of them have major gateway airport for international travelers. We also chose Anaheim and the San Diego markets because these two neighboring markets are within the proximity of Los Angeles and experience similar tourism numbers. People who travel to Los Angeles County are likely to also visit the Anaheim and San Diego market. With this info, we believe that these three markets will serve as good comparisons to the Los Angeles Long Beach market. In 2015, the Los Angeles market holds 35 million in room supply, over 15 million more rooms per year compared to the other markets, which also results in a higher demand than the other three markets. The occupancy rate of the Los Angeles Long Beach market is slightly under the tourist-filled market of San Francisco San Mateo. The market's ADR is slightly over $150, but why is the ADR for the San Francisco San Mateo market so much higher? Well, that specific market is both a major business market and a major tourism destination. Because of the new Bay Bridge opening in 2013 and also the success of the Major League Sport team of the San Francisco Giants winning titles in 2010, 2012, and 2014, results showed a higher overall ADR. Also, limited room supplies for short-term corporate bookings, the most price-insensitive guests, due to the heavy group business travelers, catapulted the rates. All these factors resulted in a high ADR for the San Francisco San Mateo market. The high ADR resulted in a significantly higher RevPAR compared to the Los Angeles market. So let's take a look at what types of businesses the Los Angeles Long Beach market will be attracting. This is the transient and group mix annual occupancy from 2007 to 2015. The data shows group market accounts for less than 20% of the occupancy. It grows slowly, and it hasn't recovered from the 2009 economics recession. To the contrary, the transient segment bounces back from the recession very quickly, and now it contributes to 60% of overall occupancy. Now take a look at the transient ADR compared to a group ADR. As you can tell from this graph, transient ADR is increasing faster and higher. Both have recovered from the 2009 recession. When we examined the weekday and the weekend occupancy pattern, we found that weekend and weekday occupancy are both high. Because the market has a diverse combination of leisure demand and business demand, the market is doing well in both midweek and weekend. The occupancy peaks on Tuesday and Wednesday because the business demand is stronger then. The occupancy also peaks on Friday and Saturday since leisure demand increases during weekends. As we mentioned, since the amount of business travelers increased during the mid of the week, the ADR is higher on Tuesdays and Wednesdays. Based on the historical occupancy seasonality diagram, we found that summer is the peak season, while the peak months of the year are March and July. Then, this graph shows the seasonality for ADR. We can see that the ADR peaks during July and August, especially in 2015 summer. ADR was much higher due to the Special Olympics. Comparing this to the last slide, we found an interesting change in the seasonality pattern. Because the occupancy peaks on March and July, but the ADR increases in March, is not as much as the occupancy increase. Why are these two seasonality patterns look different? One possible explanation could be the market demand during spring is mainly driven by business and group travelers, while leisure demand drops. For business and group travelers, they have preset corporate rates or group rates. The hoteliers cannot increase the ADR much.
In order to accommodate the growing number of visitors, hotel developers are building more pipelines in the market. Now, let's examine what is coming up in the next 3 years. This is a list of the top 10 projects by room count, which are in construction now. As you can see, Intercontinental is a luxury scale property, and it is the largest hotel in the pipeline with 900 rooms. The other properties under construction are much smaller, having room counts of less than 350. When we compare the existing supply in the pipeline, is a significant increase that a total of 14.1% room supply from pipeline will be added in the next 3 years. You may have noticed that there is no pipeline for economy scale, while upscale and independent scales are booming. Why are hotel developers not building economy scale hotels now? We think one reason might be the intensive competition for economy hotels in the Los Angeles Long Beach market. As we revealed in previous slides, the economy hotels account for 1/3 of the room supply in the market, which is quite higher than other comparable markets. The demand growth for economy hotels has slowed down to less than 1% in 2016, and the supply of the economy hotels is decreasing by 1.74%. Other concerns come from the Airbnb, which also increases the market competition for the economy hotels. We also think that the upcoming minimum wage increase of California will have an influence on the hotel developer's decision. Facing higher labor cost, it is harder to operate an economy hotel than other hotels in higher classes. In contrast to that, the hotel developers favor upscale and independent hotels. Most of these hotels are near the beach, airport, or big tourist destinations such as Hollywood. Where are there places for hotel developers to build new property? This graph shows the distribution of the pipeline supply as of August 2016. As you can see, The Los Angeles Central Business District has the most room in the pipeline, followed by Los Angeles East, and then Hollywood, Beverly Hills. Why are these places so popular? From the hotel developer's perspective, they favor the location with high demand and high occupancy. First, the Central Business District has a very high business and group meeting demand. Los Angeles East is a huge tourism demand, while the Hollywood, Beverly Hills area is very focused and attracts a lot of tourists. Besides the leisure demand, the prosperous entertainment industry in the area also attracts more business travelers.
How is the future looking for the Los Angeles Long Beach market? The number of visitors will continue to steadily increase. The supply of rooms will also continue to steadily increase. And there will be an expansion of the Los Angeles Convention Center. Due to an increase of supply in rooms based off the pipeline, increase in home-sharing businesses like Airbnb, the increase in demand will result in the occupancy rate staying roughly the same, but RevPAR growth decreasing. The ADR will be stable, although the competition/inflation in the market will result in the ADR increasing. Based on the pipeline, the Los Angeles market will have over 115,000 rooms to sell per day by the year of 2019. This project will increase the demand of meeting space. Currently, the projection completion date for the LACC Los Angeles Convention Center expansion project under the conventional municipal financing path is December 2020. According to convention center officials, the expansion plan would make the LACC more attractive for large conventions, such as Comic-Con International, which is historically held in San Diego. By size, the current facilities place LACC near the bottom of major convention centers in the United States. With the proposed expansion, the LACC would rise to the mid-range just above Anaheim Convention Center's current space. After the expansion, Los Angeles will surpass San Diego, San Francisco, and Anaheim in total meeting space.
To summarize our market study, we adopted the framework of SWOT analysis. We consider the LA Long Beach market as unique, with many strengths. First, the LAX airport is a major getaway for international travelers coming to the US. Besides LAX, the area has other airports for domestic travelers, meaning that it is very convenient for travelers to visit the area. Second, the local economy keeps growing and attracts many business travelers. The richness of their tourism, attractions, and events draw many tourists. Therefore, the market demand is quite diversified. In recent years, the market has stayed consistent in ranking within the top 10 in the US market for key performance indexes. Current occupancy, ADR, and RevPAR reach their historical records. We also note that the market has its weaknesses. For example, we think the economy class is a bit oversaturated now. The Los Angeles Long Beach market has the largest number of hotel counts in the country, causing very intense competition. Based on our interview with industry professionals, it is harder for non-branded hotels to compete in this market. From a hotel developer's perspective, one weakness of this market is the high cost for building new pipeline or buying hotel property. Another weakness is related to the increase of minimum wage in the coming years. According to the existing law in California, the minimum wage has increased from $9 an hour to $10 an hour on January 1st, 2016. Then, it will increase by $1 each of the next 5 years to $15 per hour on January 1st, 2021. This increase will cause higher labor costs for the hotel owners. Despite these weaknesses, the market has a lot of opportunities too. The area is expecting more and more tourism visitors. The new demand generators will be the LA Convention Center after expansion and the opening of the new stadium in Inglewood in 2019. Another great opportunity will be hosting Super Bowl 55 in 2021. In May 2016, NFL announced to award the 2021 Super Bowl to LA. The city will host the game after an absence of 28 years. According to the city's bidding promise, the Super Bowl will generate 60,000 hotel room nights, up to 100,000 total room nights in 2021. Another opportunity comes from overseas hotel investments, especially Asian hotel developers from China and Korea. The Asian hotel investors have developed a number of hotels in the area so far, and we believe this market will stay popular among them. Last but not least, we also notice the threats in this market. First, market competition will become more intensive due to new pipelines. As Airbnb grows, it will increase the competition as well. According to HVS's forecasting, the market's RevPAR increase will slow down in 2018 due to economic cycle. Other threats are related to terrorism and uncertainty in the global economy, which would cause the drop of market demand. Overall, we consider the Los Angeles and Long Beach market as still very attractive to both hotel developers and travelers. These are our references. We hope you enjoyed our presentation, and thank you for your time and attention.